Thanks for joining us, Arpal, and this is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon, I'm Ira Dugal. Let's get to the headlines. The Nifty and Sensex are down close to 1% each. Maruti falls the most in over a month.
Bankers warn of some short-term pain when new loan pricing regime comes into effect next fiscal, but accept that will lead to greater transparency.
The Cabinet will consider Power Ministry's proposal to ask Power Finance Corporation to buy government stake in REC today. That's according to a PTI report.
OPEC and its allies are meeting in Vienna right now to discuss a possible production cut. There's no consensus on the quantum yet.
All right, all that coming up on the show, but let's first take a look at how markets are faring. Neeraj is here with us as always. Afternoon, Neeraj.
Afternoon, guys. Well, not the best of days, and I'm just waiting to see if the European Open has any kind of impact on the Indian markets, because remember yesterday we're down about 0.5%, and then Europe started off, and then some bit of further pressure came in. For now, holding on to about that percent line, in fact off the lows of the day, if you will, if that is any solace. The volumes should come up on your screen first, and then the other items. Remember yesterday we saw a fair degree of short build up on the Nifty. In today's session, because of the Bank Nifty weekly expiry, you will anyways have the F&O volumes and the options volume being high, but already about nudging the 10 lakh crore mark. Let's see what happens in the next 2.5 hours. Suffice to say, we'll end on the higher end of the volumes front. The cash market volumes, though, a bit soft. What's doing well and what's not? Well, some of the auto names have some bit of pain to themselves. Their headlines stated about Maruti. Ashok Leyland has seen some breakdown as well. So selectively, autos are being meted out punishment. Some quality names with high P multiples are coming off. Page Industries, yet another day of correction. Just I think it's now around 24,200, 24,300 or thereabouts. So there's quite a bit of points from 35,000 highs that we had seen sometime earlier this year. It's now to about 24,000 without a quarter of a miss on the earnings in a meaningful way. It just shows the P multiple derating that has happened in a select set of names. DLF is under some pain today after having a reasonably good the last few days. So that's a set of stocks which is looking slightly wobbly. OMCs and metals, of course, looking bad on the market, on the large caps. What's doing well? A handful of stocks. Siemens on the double upgrade by Macquarie is the top gainer on the Nifty 500. So that stock is doing rather well for itself. And PFC, REC are not falling as badly. At least PFC is not falling as poorly as it was trading in trade yesterday. 5.5% down on the news. Let's see if indeed the deal does come about, then the reaction that we see on PFC after that.
That's the equities for you. Let's move. Thanks, Neeraj, for that. 10-year bond yields fell to its lowest level since April after the Reserve Bank of India said it may extend open market debt purchases till March. Lower inflation forecast is also adding to that cheer. Karthik Goyal of Bloomberg News is here to give us a quick check on how the markets are positioned and what they're anticipating.
Thank you, Harsha. Yes, there has been a complete turnaround for sovereign bonds. What a turnaround, actually. So what's happened is that we've seen a huge rally in bonds in the last 2 days, yesterday and today. The yields fell by 13 basis points yesterday. And this is coming basically on the back of the central bank yesterday saying that central bank cutting the inflation projections for the second half, and which means that markets is now pricing in that there won't be any rate hikes from the central bank. And in the top of that, in the press conference yesterday, Deputy Governor Viral Acharya said the central bank may consider extending their OMO bond purchase program till the end of March, which has come as a icing on the cake for bond market players, which means that there will be more demand for bonds, and hence that's why we see this positivity and optimism in the bond market.
Karthik, thank you so much for that. That's the bond market for you. The Reserve Bank of India has also asked banks to link all floating rate loans to external benchmarks. The new loan pricing formula will apply to retail and small business loans starting from the 1st of April. Ira is standing by to give us a sense of what this means, and will this lead to greater rate transmission? Ira.
You know, over the years in India, you've seen various permutations and combinations the way banks should be pricing their loans. Just to give you a very brief idea, at least over the last decade or so, you've seen a whole bunch of options. You know, prior to 2003, you had the prime lending rate. Between 2003 2010, you moved to the benchmark prime lending rate. Then you moved to the base rate, and then you moved to the marginal cost lending rate. And now, finally, you have moved to an external benchmarking of the lending rates. Just stay with with this for a minute. In all of these formulas, your lending rate was linked to a bank's cost of fund. The big change now is that the lending rate is going to be linked to an external benchmark. So that is the big macro change, and it'll have a whole bunch of implications. But which is this external benchmark that is being proposed by the RBI? Well, they're actually giving banks a choice in this particular matter. So there are a few options they've given. You can link it to the RBI repo rate, the 91-day Treasury bill yield, the 182-day Treasury bill yield, or any other benchmark which has been approved by FBIL. So you can choose the benchmark, the bank can choose the benchmark, and then over and above that benchmark, you build in a spread based on the credit profile of the borrower. The condition is that that spread remains constant for the term of the loan unless the credit profile of the borrower changes. So that is the new pricing regime that will be brought in. Banks, of course, will individually choose on which benchmark they want to take, and also what spread they will build in for various customer segments. But what could this mean? Broadly speaking, what you will see is a situation where you will not be, your lending rate will not be linked to the cost of funds, as I said. It will be linked to an external benchmark. And for customers, this will essentially mean two things. It's actually good for customers. It has come from the desire to make loan pricing fairer for customers. For customers, it will bring certainly more transparency because you know the benchmark, you know your spread. It's clear to you what you're being charged. But it will also bring in more volatility in EMIs because remember, if you're hypothetically linked to the 91-day T-bill and the T-bill yield shoots up, then, well, so will your lending rate. So you better be careful about that. There is also the possibility that there could be some volatility in deposit rates. Now, this has not been said by the RBI, but if banks are linking lending to an external benchmark and that becomes more volatile, then they may want to look at more floating rate deposit products, although, bankers say that's not an easy decision. So there will be more volatility, although there will be a far more transparency in the way loans are priced for retail borrowers and for SME borrowers. This rule applies largely to those two segments. What is the impact for banks? For banks, it's actually more bad than good. It forces better liability management. So in the long term, it's good, but in the short term, it's going to mean a lot of pain for banks. It's also going to make margins more volatile because from what we understand, the margins now are far more dependent on a benchmark that the bank doesn't have control over. So that's going to be tough for banks. But the big picture behind this is the economy. This entire change has been driven by the concern that monetary transmission or interest rate transmission in the Indian economy has not been very effective. You've been hearing lots of complaints about RBI changing rates, but banks not changing rates, moving to the upside far more quickly than they move to the downside. So that's the big picture behind this change recommended by the RBI. So the expectation is that this will lead to stronger monetary transmission, better credit behavior. The reason this has been put there is because borrowers will be more careful about their credit behavior because if their credit score changes, then the spread changes. So better credit behavior perhaps from borrowers, and finally improved liquidity and risk management for banks. This is of course all theoretical. This comes into play starting April next year, so we'll see what it actually finally pans out as.
Thanks, Hira. Axis Bank's retail division head Rajiv Anand says consumers need to realize that transparency will also lead to higher volatility, the point that Hira was making.
I think one of the key things, particularly for a retail customer that one needs to recognize is that while on the one side we will certainly see greater levels of transparency because we are now using an external benchmark, it also means that there is greater level of volatility. And this greater level of volatility will come through, because repo rates have changed, or sort of there is some tightness in the market, and 182-day T-bill rates have gone up or down, or the shape of the curve has in a sense changed, meaning that the short end has tightened, but we are going to see a long end rally. All these various permutations and combinations could drive change to the benchmark, which will in turn get passed on almost instantly to the customer, both positively and negatively, which means that transparency will come at the cost of volatility as far as customers are concerned. And an important point that I want to make here is that what tends to happen, and this is normal customer behavior, is that if my EMI is 100 rupees and that has now come down to 90, typically I would sort of spend that 10 rupees away. However, when the 100 rupees becomes 110 rupees, then I will no longer spend that 10 rupees. I will spend that 10 rupees. So my salary or whatever still remains the same, and therefore it becomes a bit of a struggle to be able to fund that extra 10 rupees on a monthly basis. And what one would expect the retail customer to do is to be disciplined both on the way down, such that he's built some sort of a buffer for when interest rates do go up. But generally speaking, retail customers don't think in that manner. But now in this new environment, managing your cash flows is going to become more and more important.
No, 100% Rajiv. So firstly, I assume that the choice of benchmark will be the banks, not the customers. Is that right?
Absolutely. So we're doing some work around, taking wearing the customer lens to ensure that the levels of volatility are minimal, but at the same time ensuring that return on equity for us, etc., still continue to be managed in the manner that we want it to be managed. We're doing some work around which is the most appropriate benchmarks to use, and we will come up with the appropriate one at some point in time.
Okay, Rajiv, one of the criticisms again on the benchmark is that all of these are far more shorter term in nature than, say, a housing loan, because I think it's the housing loan portfolio that will get most impacted. Could customers see a scenario where different banks choose different benchmarks? But even if that happens, I guess the comparison is easier, right? You can compare the spread across different banks, you can compare the benchmark, decide which one works best for you. You can take an interest rate call and potentially pick the best option for you.
Easier said than done, Neeraj.
Yes, I know.
I think the risks is really the point that you make, that for a home loan, different banks could use different benchmarks. Different banks could assess you from a credit perspective differently. And so therefore, how are you going to put all that on a spreadsheet and try and figure out what is the best for you? Because a particular bank may give you a absolute rate which is lower today, but could also mean that you will see higher levels of volatility as you go forward. And so therefore, how are you going to assess the benefits or otherwise at the short term and versus volatility that could come in the long term? The other important point also is that the way that it currently reads is that this benchmarking is only applicable to banks. I do hope that as we go forward, as you think about the customer, you don't want to be in a situation where not only do you have multiple benchmarks from multiple banks, but a completely different way of calculation of rates through the NBFC sector, for example. And so therefore, making a informed call or making that choice between multiple banks and the NBFCs at any point in time is certainly going to get more complicated. And I think we certainly need to sort of work through this to make it as simple as possible for the customer.
Rajiv Anand from Axis. Let's move on. The government may ask power finance companies to buy its entire stake in REC, a U-turn of sorts from what had been floated earlier. The cabinet is expected to take up the power ministry's proposal today. Yatin is standing by to tell us if shareholders stand to gain from this potential deal.
Afternoon, Harsha, and as we were mentioning earlier, it's a complete U-turn. And now what we understand from PTR report is that the government would consider a proposal for PFC buying out the government stake, which is almost 52.6% in Rural Electrification Corporation, which is REC. Now, at the current market price, we could have a valuation upward of 10,000 crore for this stake, which means that the government is eyeing this 10,000 crores via the stake sale. Now, what really happens is that on the concern side, as we saw in the case of ONGC HPCL transaction, is that there could be a holding company discount for PFC when it acquires REC shares, which means that from day one, we had a valuation contraction kind of a scenario. And more importantly, given the fact that REC has less than 1,800 crores worth of cash on the balance sheet, a 10,000 crore acquisition would clearly mean that PFC would have to leverage its balance sheet in order to acquire this stake, and more importantly, they will also have to compromise on the lending and the capital adequacy ratio, which will fall in post the cash outgo which will happen. Of course, as a shareholder, the concern would be the management control issue, because till date HPCL has not classified ONGC as its promoter, and there is tussle which usually happens between the two boardrooms. And if this case were to happen with PFC REC, then probably a minority shareholder or any kind of a shareholder is stand to lose. More importantly, there could be exemption of the market regulator when it comes to the open offer, because since the stake sale is more than 25%, there will be a 26% open offer which needs to be given as per the law. But usually we have seen, and ONGC HPCL deal has set a precedence that such kind of a transaction will be exempt for open offer, and probably that would also be a shareholder concern when the final deal structure fructifies.
How would you, if you compare REC and PFC on financials and valuations, how do they stack up?
Well, REC, probably is in a better position than PFC when it comes to the balance sheet side as well as on the asset quality side. Now, if you look at the FY20 estimates, REC trades at nearly 0.57 times price to book value, which is estimated. Similar is the case with PFC. So both of these companies probably trade near half-time book valuation based on FY20 Bloomberg consensus estimates. And more importantly, if you look at the asset quality also, PFC has been under pressure because of worsening asset quality in the power sector. In fact, the gross non-performing loans for PFC stood at over 28,000 crores, and the same as on second quarter was little over 20,000 crores for REC. And if you look at the brokerage view also, brokerages do believe that REC has a better return potential than PFC. In fact, the Bloomberg consensus return potential shows that REC would have a 30% plus kind of a return potential in the next 1 year versus 18% to that of PFC. So on REC side, of course, the valuations are slightly richer, and if the valuation for REC goes up when the actual valuation happens or the actual share transaction happens, probably PFC would have to pay a premium to the REC shareholder, which is the Government of India.
All right, Yatin, thanks so much for that. First, Zydus Wellness struck a deal with Heinz, and then the Unilever GSK deal came in soon after that. While both sides got a clutch of brands, the battle, experts say, is to gain a bigger share in the malt health drinks space. So who paid more for the brands, and what else was thrown into the basket? Agam Akil is here with us. Agam.
Sure. So, well, considering these acquisitions came in very quick succession, I thought it was an interesting way to look at things, how valuations for both these acquisitions have stacked up, and what both these acquirers stand to gain. So I'm going to start with the HUL portfolio, what they have at this point in time, and what the Horlicks portfolio can bring to them. So at this point in time, HUL does not have any malt-based drinks. They do, however, have something like a Brook Bond in the beverages space, but in the foods business, otherwise it's largely Knorr, Quality Walls, and Kisan. Of course, that sees an addition of Horlicks, Boost, and Horlicks and Boost together have market share of around 64%. So this is going to be a very big addition to their portfolio. Moving on, as far as Zydus Wellness is concerned, again, they do not have any exposure to the malt-based health food drinks segment, but Complan, which has a market share of around 8 to 10%, will add to this portfolio, which has sugar-free, Everyuth, and Nutrilite. We all do know that Glucon-D is another very important brand which has been around for decades, and that also adds to Zydus Wellness. But that said, what about the revenues, and why is it that, well, perhaps HUL has a little bit of an advantage here? So if you look at the way revenues have panned out for both these companies, GSK's revenues have risen by as much as 2% on a CAGR basis. On the other hand, there's been a compounded annual contraction for the 4 brands that Zydus Wellness has bought in the last 2 years. Of course, when it comes to margins, they both stand at around 20%, 19% to be precise for Zydus Wellness, but there isn't really too much difference between the two. The market share for malt-based drinks is the key factor here, and this is where I want to bring out the 50% market share for Horlicks, another 14% market share for Boost. Both these together, 64% market share goes to HUL. You have about 8 to 10% market share for Complan here. And well, some may ask, where does Cadbury's Bonvita stand here? Well, according to Euromonitor, that stood around 14% as of 2017, and that would be a part of this 26% here. But as you can see, clearly the bulk of the market share is with Horlicks and Boost, and that is the big advantage for HUL as well. Let's move on and then compare your deal valuations. Now, the simplest way to go about this is to take the deal value and divide that by the turnover of that company. And as you can see here, the deal size to turnover for Unilever GSK stands at around 7.4 times. That's a significant premium to Zydus Wellness's buyout of the Heinz brands. But the reason behind this is clearly the fact that, well, GSK brands enjoy a higher market share, and of course the revenues that we've seen in terms of growth, and of course it is immediately EPS accretive. As for Zydus Wellness, well, the deal could be dilutive, at least in the near term, and these are some of the various factors that have led to that significant premium for the GSK HUL deal.
Agam, thank you for that interesting comparison. Let's talk about oil now. Oil prices have taken a U-turn since the last OPEC meeting, prompting oil producers from across the world to call for a production cut. Meanwhile, President Trump's already made public his displeasure at such a call. But today's meeting at Vienna assumes significance. It has another factor at play, the controversy surrounding the killing of journalist Jamal Khashoggi. Bloomberg's Anthony DiPaola joins us from Dubai with expectations of what's likely to happen. Anthony, what do we know and what's the expectation?
Good morning. Well, what we know is that the OPEC ministers have said in a couple different settings leading up to this meeting that they see the market oversupplied now, and they see that oversupply increasing going into next year. Demand forecasts have come down a little bit from the demand growth of this year, and we see a lot of U.S. shale oil coming on the market. So that's going to take up pretty much all of that increase in demand and then some. So that's squeezing some OPEC oil out of the market if the OPEC ministers do decide today to cut. We do expect that they will make some decision on cuts, but really the number of barrels that they'd like to take off the market is still to be decided. There is some difference between the members there. Saudi Arabia and Russia, those are the two main partners in this OPEC plus grouping that's going ahead with the cuts. They've agreed to work together in terms of managing the market at least through the first half of next year. That will likely include some cuts, but that's still what needs to be decided in OPEC if the Saudis can bring on other countries to take some barrels off the market. So that's what we're waiting to see today.
Anthony, many thanks indeed for joining us. That's Anthony DiPaola reporting from Dubai. Qatar, which is on its way out of the OPEC, believes that there is an oversupply in the market. The country's energy minister told Bloomberg's Anne-Marie Hoden that while the nation would prefer a production cut, it will leave it to the OPEC members to take a call finally.
The market is oversupplied. I think that a cut could be something that would help the market, but it depends on a lot of seasonality and other things that could happen in the future. But we really didn't focus on that area much, and as I said, because we're not a big player in the oil, that's something we leave it to others to look at and decide what they want to do as OPEC.
All right, let's also get in Azlan Ahmed from Singapore. She's the editor of crude oil markets at Argus Media. Azlan, thank you so much for joining us. What are you making of these developments in the oil market? There's been a sudden U-turn on whether a production cut is needed or not. A couple of days ago, you did see Qatar exiting the OPEC. Does all of this have material impact on how oil prices are going to behave?
Well, I think the oil prices, how the oil prices behave will depend on what happens with the OPEC meeting today and tomorrow, because that's key, obviously. Part of the reason the supply on the market has increased, but that's also partly because the initial expectations was that we could see a much bigger drop in Iranian oil exports because of the U.S. sanctions. But the U.S. last-minute decision to give waivers to 8 countries for 6 months has eased the supply shortage worries. And Saudi Arabia had been increasing its production on the request of the U.S. in anticipation that the market would see a big loss in Iranian exports. And that actually has not materialized as drastically as the market expected. So all that, I guess, kept the market well supplied over the last month, and we saw that already in the oil prices falling. So with expectations from the market is that there needs to be a production cut from OPEC and its allies if it wants crude prices to recover or rebound. But how much OPEC will cut and how it will be divided, I mean, that's key to the meeting today and tomorrow, and which is what the market will watch very, very closely.
Irrespective of how much production cut is decided on today, Azlan, there's also a report that there's been an uptick in the inventory, the U.S. inventories as well. Is that likely to put a lid on prices?
Well, I think that we're waiting for the EIA data to come out tonight. It's a little bit. It's a day later because of the U.S. Because of the public holiday in the U.S. because of the memorial service. So I guess the market is watching that closely. At this point, the expectation seems to be that there will be quite a significant increase in the U.S. crude stocks, mainly because we've seen a steady increase in the U.S. crude stocks for the past 10 weeks. And also, as you know, the reports of API data showed a rise in crude stocks. So at this point, today, right now, the market is anticipating that we will see another rise in the weekly crude stocks. So if that happens, I think that has almost been factored in for at least today. So I don't think that we're going to see a sharp drop in the prices today, because the market will not want to sort of like take positions until there is some certainty about what the OPEC producers and its allies, which is mainly Russia, will do over the next few months.
Azlan Ahmad, we leave it there. Many thanks indeed for joining us.
That's a wrap on this edition of Power Lunch. Thanks so much for watching.
Thanks for watching.